In this video, we're going to be looking at an example for step 4 of revenue recognition. You now know that there are 5 steps companies must follow to recognize revenue. If a contract has multiple performance obligations, we need to allocate the transaction price to the different performance obligations in the contract. How do you allocate the transaction price? Well, it can be based on one of two things. Either the individual selling prices, if the company has individual selling prices, or fair market values of each item that was sold. Your question is going to provide this information. Let's take a look at an example. In this example, it says ABC company sold 1,000 units of product A and 1 year of service B bundled together for $250. They sold 1,000 units of this bundle, and each bundle was $250,000. And then they received $250,000 cash for that sale. ABC normally sells product A for $225 and 1 year of service B for $75. They want to know when is revenue recognized and how much revenue is recognized. So let's take a look at what ABC is selling. So they said ABC had a product A and a service B, and they're bundling it together and selling it for $250 each. They sold 1,000 units of this product. That's how they received the $250,000. Next, A and B is sold separately by the company, and A is sold separately for $225 and B is sold separately for $75. So if you add that together, the separate price of A and B is more expensive than the bundled product. So what we need to know is multiple things. When we're looking at revenue recognition, the first thing we need to know is follow those 5 steps. Do we have a contract? Yes. Are there multiple performance obligations? Yes, there are multiple performance obligations. The multiple performance obligations are we're selling a product. That's one. But we're also selling 1 year of service. That's the second obligation. So this is 1 year of service. So in this example, we are selling 2 items or 2 things for one price. We bundled these together for $250. But since we're selling 2 different items, we need to split this $250 to see how much of this $250 would belong to the product and how much of this $250 would belong to the service. To do that, what we do is we use the relative selling prices. Now, if they didn't have selling prices, we use the relative fair market values. Either the selling prices or fair market values would be provided for you in the question. Your first step to solve this would be to list out the products, the separate products. So we know that we got product A, we've got product B, or actually it's a service, and then we have the bundle. So you're going to set up your answer like this. In the first column, you're going to list out the selling price or fair value, depending on what they have given you. So selling price or the fair value of A, B, and the bundle. We know that the selling price of A is $225 as a standalone. Selling price of B is $75. If they bundled it together, A plus B, it would be $300. That's step 1. Step 2 is to figure out how much is the selling price of A and B in relation to the total. In fact, let's not call this bundle, let's call this total so that it is less confusing. So we're trying to figure out what is the proportion of A in relation to the total and what's the proportion of B in relation to the total. To do that, you start with the A's price, 225, divided by 300, and you can multiply that by 100 to come up with the percentage, and you find that A is 75% of the total of A and B. Now let's look at B. We're going to take 75, which is the selling price of B, the total of A plus B, which is 300, multiplied by 100, that gives you 25%. That's step 2. So step 1, you list out either the selling price or the fair market value depending on what's given in the question, and then the total, and then calculate what percentage of the total is each performance obligation. These two together should always make up 100%. 2 or 3 or however many performance obligations should always make up 100%. Now that we know what percentage each item is of the total, we will multiply these percentages by the selling price of the bundle. The bundle was sold for $250 and the bundle contained A as well as B. So what we will do is we will multiply these percentages by the selling price of the bundle, which we know was $250, and that will tell us how much we can allocate to product A and how much we can allocate to service B. Once you multiply 250 by 75%, you will get $187.50. And if you multiply 250 by 25%, you will get $62.50. So this $250 that we sold the bundle for, of this 250, $187.50 was for product A and $62.50 was for the 1 year of service. Now we can recognize revenue and record it. Again, these were for individual. We know that we sold 1,000 of these units, so let's multiply this by 1,000 and we get the total amount for product A was $187,500 and the total amount for service B was $62,500. If you add these two numbers together, you should get $250,000, which was the total amount we received in cash. Another option you could do is, instead of multiplying these percentages by 250, you can multiply these percentages by the entire 250,000 and you would still get the final answer here. Now let's see how this would be recorded. On the date of sale, we know that the company received $250,000 cash. So the cash account would be debited for $250,000. Product A is one performance obligation. Service B is the second performance obligation. A was delivered immediately to the customer. The company has no more duty remaining towards product A because that was delivered. We have done our part. We can recognize the revenue. So in our revenue account, we're going to recognize the amount of revenue for product A, $187,500. For service B, we're not done yet. We just started. We have to provide 1 year of service for us to recognize that revenue. We received the cash of $62,500, but we still haven't provided the service. So $62,500 would be deferred. It would be the deferred revenue or the unearned revenue account. So deferred revenue would be credited for $62,500. Again, I want to remind you that deferred revenue is the same as unearned revenue. As time goes by and this company earns this revenue that's deferred, what they will do is they will debit deferred revenue and credit revenue. This could be done every month if they are preparing financial statements every month, or it could be done at the end of the accounting period as an adjusting entry. That's it for this video. Please let me know if you have any questions.